and welcome to come to share, to learn, and to exchange your knowledge and expertise in your professional field. The purpose of CPA Australia Discussion Group is to provide a forum for like-minded members to exchange information and share knowledge on topics of common professional interest, and CPD hours can be claimed for discussion group sessions with appropriate professional content. We believe that our discussion group is here to serve people and solve problems, and also to support members, support professionals, support businesses, and support community, because we believe together we can make a difference. Just a few housekeeping. If you have any question, please raise them in the chat box. If we were unable to address all the questions during this webinar, we'll take them offline to the speaker. The webinar and all chat history are being recorded, and subject to the consent of the speaker, we may publish the recording and relevant presentation material via email system in the next few days. For anyone attending via telephone audio dialing, if you can email us your name and the phone number you used to dial in so we can record your attendance as well. So thank you for your support, and please let us know if you have any feedback via our email, which is members@citytaxation.com.au. And also, if you're on social media, please hashtag CityTaxation, hashtag CPA Australia, hashtag Together We Make a Difference, and share any insight you think relevant and will benefit other members. So this afternoon, we are privileged to welcome Jonathan Ortner, partner at ABL Lawyers, and Michaela Burnfield, senior associate at ABL Lawyers. Jonathan is a partner in the firm's taxation group and practices in all areas of direct and indirect tax, with a particular focus on taxation of trust and corporate income tax and merger and acquisition. Jonathan has also advised extensively on cross-border taxation issues, employment taxes, including the tax treatment of employee share scheme, termination payments and fringe benefits, and the GST implication of transactions and dealing in the development of property. Using his technical tax knowledge, Jonathan works with clients to obtain commercial and practical outcomes. He has particular experience in dealing with the Australian Taxation Office on complex tax issues in a dispute resolution and transactional context. Michaela advises on a range of federal and state tax matters, including the taxation of trusts, corporate income tax, goods and services tax, and payroll tax. She also acts for client in dealing with the Australian Taxation Office on complex tax dispute. So please welcome Jonathan and Michaela.
Thank you very much, Teddy and Henry, and it's great to present again, and on a topic that is close to my and Michaela's heart at the moment, given for the last 2 years we've been presenting on this, and probably really over the last 6 months we've seen an increased focus by the ATO on the application of these provisions, and it's resulting in a number of disputes, significant disputes, which is warranting further attention, particularly around how the ATO might be able to administer the provisions sensibly, and whether, given the current state of the provisions, their complexity, their uncertainty, if it's warranted to go to Treasury and seek legislative reform, because some of the outcomes are so perverse at the moment. It's a very punitive regime that, in my view, was not intended to operate in this way. If you go back and look at, the revenue forecast when the provision was introduced, it was negligible, and this is suddenly becoming a significant revenue-raising provision for the Commissioner, which, again, I think is the antithesis of what the provisions are about. What we're seeing in practice are all sorts of different issues, as I said, arising from, in some respects, uncertainty around how the provisions work, but also because of the systems in place by the ATO, uncertainty about what elections actually exist and what don't. In some cases, elections are suddenly showing on the ATO's portals when they were advised, taxpayers or accountants were advised that there were no such elections in place for the particular trusts. On top of that, there's been debates about the validity of elections being made when such elections haven't been signed appropriately, and all of this has led to the sort of position that we're in at the moment. So we'll try and get through as much as we can in today's session. It is a lot to speak to in a 45-minute time slot, but to the extent we don't address everything. We do have a paper that we can circulate as well that was published through the Tax Institute that will provide a lot of detail on some of the issues that we're seeing. Michaela, if you wouldn't mind just going to the next slide. Thank you. So what are these provisions? Why do we have them? What are they all about? And, you know, when do you really need to be making an election? As sort of the starting questions. The background to the family trust distribution tax provisions has its genesis back to the introduction of the trust loss regime in Schedule 2F to the 1936 Act. And back in the 90s, there was a view at the time that trusts were a more favourable vehicle in some respects because they weren't subject to the same stringent loss carry forward rules that their companies were subjected to. And that resulted in, you know, trust loss trading schemes, which Treasury of the day felt that they had to crack down on. And as a result, we had the introduction of the trust loss regime. Now, involved in that process was a debate about the application of those provisions to particular types of trusts, including family trusts. It was felt that where a particular species of trust was established that confined the people who could take from that trust to a subset of a family group by reference to a primary individual, then the sort of mischief that the trust loss rules were aimed at wouldn't exist. And as a result, the introduction of the family trust became a concept that found its way into Schedule 2F, and then later on into other provisions to deal with similar issues around concessions being given to trusts. So if we just go to the next slide, these are the other types of benefits where you will find the concept of a family trust. So the trust loss measures, as I say, one of the benefits of being a family trust is that you only need to satisfy one particular test, which is the modified income injection test, as opposed to the series of other complex loss carry forward tests, which typically would be difficult to satisfy, if not impossible, for a discretionary trust. So if a trust has trust losses, or tax losses, I should say, then those losses will be available to be carried forward so long as you satisfy the modified income injection test. That is distinct from capital losses, I should say, which Schedule 2F does not deal with. So capital losses are not subject to these tests. The other benefit is where franking credits are passing through a trust, because a trust holds shares in a company which pays franked dividends. Typically, the only way in which a beneficiary of a discretionary trust will be entitled to the benefit of those franking credits is if a family trust election is made in respect of the trust flowing through the franking credits. The only other way that you would be able to get the franking credits is if the de minimis test of $5,000 is met. But when we're talking about franking credits of more than $5,000, typically you'll need to make a family trust election. There are some other concessions around company loss tracing and also trustee beneficiary reporting rules, which become simplified or simply do not apply. But frankly, the most important two reasons that we see in practice as being reasons for making a family trust election come down to the ability to carry forward tax losses and the ability to flow through franking credits. I think I'll hand it. Is that?
Thank you.
Michaela?
Thank you, Jonathan. Apologies. I'm having some trouble with my video. But I will now take you through what the requirements are for making a family trust election. And there are essentially 4 requirements. The first is that the election must specify a test individual whose family group is taken into account in relation to the election. The second is that the election must be made in writing and in the approved form. The third is that the election must specify an income year for which the election will apply from. And the fourth requirement is that the trust must pass the family control test. Now, today I will just touch on a few aspects of each of these 4 requirements. But before I do so, I just want to note from the outset that a trustee can only make a family trust election in relation to a trust once. And if that election is made, it can only be varied or revoked in very limited circumstances. So this should be borne in mind before entertaining any of the 4 requirements for making a family trust election. Now, the first requirement, specifying a test individual. Selecting a suitable test individual is critical, as it is this particular person who is essentially the point of reference for defining who the family group is in relation to the family trust election. And who the family group is in relation to the election is itself critical, as any conferrals of present entitlements or distributions of income or capital that are made by the family trust, so the trust that has made the family trust election, or an interposed entity, will trigger family trust distribution tax if that conferral or distribution are made to a person or entity that is not a member of the test individual's family group. So selecting the test individual is critical. But while selecting the test individual is critical, it is important to bear in mind there is one limitation on who that individual can be. Now, the ATO take the view in ATO ID 2014-3 that the test individual must be alive at the time that the trustee makes the family trust election. Whilst this limitation may seem quite straightforward, what it means is that when selecting the test individual, it may involve some forward thinking and perhaps even some succession planning, as selecting the appropriate test individual is not just about defining who the family group is at present, but also defining the parameters for the types of entities and people that will be members of the family group going forward into the future. You may want to, for example, provide the descendants of the test individual with the opportunity to make additional family trust elections for additional trusts that exist or are established in the future within the broader family group. They might want to specify the same test individual for those additional trusts, but the descendants will only be able to specify the original test individual for those additional trusts if that original test individual is alive at the time that those additional elections are made. Now, with that being said, if it becomes apparent that the test was originally selected is not the most appropriate person to have chosen, it is possible to vary an election so as to choose a different test individual, but a variation can only be done once, and it can only be done if 2 requirements are satisfied. The first is that the new test individual must have been a member of the original test individual's family at the election's commencement time. And the second requirement is that whilst the election has been in force, no conferral could have been made to any other individual or person other than the new specified individual or members of the new specified individual's family group. The test or the rules also, sorry, I'm getting some reception issues, allow a variation in other circumstances, broadly ones which involve a marriage breakdown. So I won't go into those today, but in any event, a variation must be made in the trust tax return for the income year in which the variation is to be effective. And if the trust is not required to lodge a return for that income year, the variation must be made in writing in the approved form, must specify the income year for which the variation is to be effective, and must be given to the commissioner within a certain period of time. Sorry, Teddy and Henry, can you hear me, or is my reception cutting out? I'm just
No,
getting a
we can hear
few.
you. We can
Okay,
hear you.
great. I'm just getting a few notifications.
That's all right.
Okay, so moving to the second requirement. The election must be made in writing and in the approved form. Now, the phrase approved form is defined in Section 38850 of Schedule 1 to the Taxation Administration Act 1953. And that definition has 4 requirements. The first is that the document must be in a form approved in writing by the Commissioner. Now, the ATO has approved the document known as Family Trust Election Revocation or Variation 2025 with reference NAT 2787. This document appears in the ATO's list of approved forms on the ATO website, so it is publicly accessible if you want to go and look. The second requirement is that the document must contain a declaration signed by a person or people as the form requires. And based on NAT 2787, this declaration must be signed by the trustee, and if the trustee is a company, must be signed by the public officer of the company. The third requirement is that the document must contain the information that the form requires. And based on NAT 2787, this would be information such as the name and address of the trust, as well as the specified income year for which the election is to apply from. And the fourth and final requirement is that the document must be given in the manner that the Commissioner requires. But this fourth requirement is only a requirement if the document in question is required to be given to the Commissioner. Now, in the case of family trust elections, it has not been a requirement for the election to be given to the Commissioner since the April 2005 legislative changes. So that's very important to keep in mind. And if we just look at the first 3 requirements, assuming that those are the only requirements that are relevant for the moment, none of these 3 requirements seem too controversial, but where they may become controversial is where there is perhaps a dispute as to the existence of the family trust election. Where, for example, the Commissioner is arguing that the family trust election was made and exists, whereas the trustee is arguing the opposite. And that is essentially what took place, or the type of dispute that took place in the case of Widdop. The citation for the federal court decision and the full federal court decision are on the screen for your reference at the moment. Essentially, what took place in that case was that for approximately 8 years, the trustee had indicated in the trust tax returns that a family trust election had been made. It did so by ticking the family trust election status. In 2017, a capital gain was made and was distributed to an entity that was not included in what was believed to be the family group of who was believed to be the test individual. Now, what the trustee subsequently did in the trust's 2018 tax return was it left the trust's family trust election status blank. Later, the Commissioner subsequently issued notices imposing family trust distribution tax and for various other reasons issued amended income tax assessments and notices for administrative penalties. Now, the cases that you see on the screen at the moment did not primarily concern the disputed liabilities. Rather, they concerned freezing orders that had been made to the Widdops in connection with the disputed liabilities. But whilst the cases did not concern the disputed tax liabilities, both of the courts did provide some comments in relation to the Commissioner's case insofar as the disputed liabilities were concerned. And it did so because in determining whether or not the freezing orders that had been made to the Widdops, whether they should have been made in the first place, one of the things that one of the things that the court was required to consider was whether the commissioner had a good or reasonably arguable case on a prospective cause of action. And to this, the commissioner argued that it did, and that it did because the trust in question was a family trust under Schedule 2F and for Schedule 2F purposes. And the commissioner's case was, in terms of this, that it could be inferred that a valid family trust election had been made based on what was said in the trust tax returns for those 8 or so years, and the fact that historically all distributions that had been made by the trust to anybody had always been made to individuals within the Widdop family or companies that were associated with the Widdop family. So on that basis, and having regard to the fact that the distribution had been made to an entity that was said not to be a member of the family group, the commissioner's case was that the trustee was liable to family trust distribution tax. Now, whilst the primary judge nor the full federal court made a decision as to whether or not a family trust election had validly been made, what the court did hold was that the commissioner it was open to the commissioner to find that a family trust election had been made, and therefore the commissioner had a good or reasonably arguable case on a prospective cause of action. Both courts, however, left the Widdops to prove through evidence, specifically in Part 4C proceedings, that an election had been made. But unfortunately, this Widdop case did not progress to any Part 4C judgments. So whether or not the Widdops actually made a family trust election or not was left unresolved. There is, however, and I have cited this case at the bottom of the screen, and that is there is a tribunal decision, BRKK and Commissioner of Taxation. This decision that I have cited is an interlocutory tribunal decision that was made in October of 2024. We don't have too much information on this case, but what we do know is that it's connected to substantive proceedings where, amongst other things, the question is whether or not family trust elections had been made or not. We're not entirely sure where the substantive proceedings are at the moment, but perhaps we will have a Part 4C judgment on this issue in due course. Moving to the third requirement. Now, the third requirement for making a family trust election is that the trustee must specify an income year. The legislation is not as overt when dealing with this specific requirement, but what it is overt in dealing with this specific requirement is where it deals with specifying an earlier income year. And what the legislation says is that a trustee may specify an income year that is an income year before the one in which the election is made if 2 requirements are satisfied. The 2 requirements are the family control test, which we'll discuss in just a moment, must be satisfied from the beginning of the specified income year up until 30 June of the income year before the income year in which the election is made. And 2, during that period, any conferrals of present entitlements or distributions of income and capital must have been made to the test individual or members of the test individual's family group. In our view, failing these 2 requirements would invalidate the election completely. And the federal court decision in Advanced Holdings seems to support our view on this. The court in that case did not deal with the legislative issue as such, but it did hold on the evidence that, as a matter of fact, since those two requirements were satisfied, the election in question was valid and effective from the earlier specified income year. There is one last point I want to mention in terms of this third requirement, but I'll quickly jump to the fourth requirement first. For making a family trust election. And that requirement is the trust must pass the family control test at the end of the specified income year. Now, the legislation is very clear in terms of this requirement, that the trustee must not make an election unless the family control test is satisfied at the end of the specified income year. So based on this drafting, it's clear that the earliest point in time in which an election can be made is immediately after the specified income year. And I just want to reiterate this point because it seems at least clear to us that the specified income year must always be an income year that's before the one in which the election is made, simply based on how this family control test requirement is drafted. And so in our view, those two requirements that I just mentioned, which are relevant when specifying an earlier income year, seem to always be relevant. What the family control test is, it's defined in detail in the legislation. I won't go into the detail, but essentially there are there's 7 ways in which one can satisfy the family control test. Each of these ways is essentially looking at a certain group having a certain level of control over the trust. And who that certain group is depends on which of the 7 ways you're seeking to satisfy that family control test. So it's all set out quite clearly and in detail in the legislation for your reference. But for now, I will pass you back to Jonathan, who will take you through what happens when you misstep the family trust election rules.
Thanks, Michaela. So when you breach these provisions, it isn't a very good outcome, as you're probably gathering. And so I'll just step through very carefully what it does mean for taxpayers. The first thing to note is that family trust distribution tax is assessed under the Family Trust Distribution Tax Act, abbreviated. It's not actually an income tax subject to the usual assessment procedure that the Commissioner has to go through. What that means is that once you have breached the provision, that means that the debt becomes due and owing to the Commonwealth, unlike for an income tax where you actually need the Commissioner to issue an assessment to create that debt due and owing. Why that's relevant is that because at the time of the breach, the debt becomes due and owing, the general interest charge can then be imposed within the period specified on the screen there. And the GIC, as you know, is the highest rate of interest that can be charged. Now, given that there's no period of amendment, in other words, the Commissioner can go back to when these rules started in 99, if you've had a breach going back that far, when you add in GIC, you can very quickly get into the tens or hundreds of millions of dollars, depending on the group size. And that has the potential to create bankruptcy and insolvency issues. So we're talking about very, very significant liabilities, a very punitive regime. The other thing to note is that the liability for family trust distribution tax is not just limited to the trustee. It can also expose the directors of the trustee company, and they are jointly and severally liable. Likewise, for companies that have made interposed entity elections, if the company has breached the provisions and caused a tax liability at the company level, then the directors may become jointly and severally liable. So there is personal exposure as well as entity exposure. The one thing that the rules do to try and alleviate some of the adverse, implications here is to prevent double taxation. But it's not a perfect system, which I'll come to in the example on the next slide. Typically, what the provision does is it makes the distribution that was otherwise accessible to the beneficiary non-accessible, so that the trustee is only taxed and not the beneficiary as well. And that tax is levied at 47% on the amount or value of the income or capital. So if we go to the next slide, and I'll just work through an example. So in this particular case, we've got ABC Co, an Australian company, which derives, for these purposes, rental income of $100,000. Now, ABC Co, assuming it's not a base rate entity, pays tax at 30%. So it has $30,000 of tax to pay to the ATO. And let's say it distributes a fully franked dividend to its sole shareholder, 123 Trust. So $70,000 grossed up for $30,000 of franking credit. So $100,000 fully franked dividend. 123 Trust has a family trust election in place to ensure that franking credits can flow through to its beneficiaries. And individual A is the test individual. So the trustee exercises discretion to distribute the dividend to a distant relative of the individual. And whilst that individual is a beneficiary of the trust as defined under the trust deed, unfortunately that person does not meet the definition of the individual A's family or family group. And as a result, that distribution has been made to what we refer to colloquially as an outsider, and family trust distribution tax will be triggered for the trustee and possibly then for the directors who are jointly and severally liable if the trustee can't meet the liability. So the question is there double taxation? Now, the way the provision in Schedule 2F will work is that it will make the receipt of the distribution by the distant relative non-assessable. So prima facie, that beneficiary being presently entitled to this dividend would have paid tax. But because of the application of the family trust distribution tax rules, there will be an amendment to individual A's tax return and a refund of tax paid. And instead, the trustee will be liable to the family trust distribution tax. Now, that goes some way to alleviating double taxation. However, because the dividend is essentially denied and instead the trust is taxed, there's a loss of the franking credits. And so what happens is there's 47% tax on the $70,000 cash dividend that's actually paid, being the value of the capital or income that's been appointed to the outsider, but the $30,000 of franking credits are lost. So that's a sting in the tail that perhaps is not always thought through, and the double tax relieving provision is not perfect in the way that it operates. We just jump over to the next slide, Michaela. So now we get into the concept of a distribution. So there's distributions in the ordinary sense, which apply for trusts, partnerships, and companies. And they are what you would typically expect a distribution to be, in that you've got a payment of income or capital to a beneficiary in their capacity as beneficiary of the trust. And likewise, if we go over for a company to a shareholder, and that's when you've received a distribution of capital or dividends. And likewise for a partnership, again, an appointment of income or capital to a partner in their capacity as a partner in the partnership. So that's all relatively straightforward and well understood. Where people can fall into the trap with these provisions is the broader meaning of distribution, and distribution going to persons who aren't necessarily beneficiaries or partners or shareholders. So in other words, this provision here, 27260, captures circumstances in which there's a distribution of income or capital to someone other than a beneficiary or partner or shareholder. The Commissioner originally had a view that this provision only captured, in the case of a trust, distributions to beneficiaries. But he then reversed that view in TD 2017/20 and said, because there is no mention of beneficiary like there is in the other provision dealing with distributions to beneficiaries, that the better view is that this provision is intended to be expansive in what it's capturing and includes third parties that aren't beneficiaries. So that if the distribution, for example, is made to someone other than a beneficiary and that other person is an outsider, then family trust distribution tax can still be imposed. Now, there is a limitation on the definition of distribution here, unlike the other three provisions that you just saw, and that is where there is an amount that has been paid to someone and consideration has been provided for that something, then there'll only be family trust distribution tax imposed on the excess of the amount paid over the consideration given. So to take a very simple example, if the trustee transfers a car that's worth $100,000 to an outsider and the outsider pays $100,000, then there will be no family trust distribution tax because market value consideration has been given. If, however, the market value of the car is $100,000 and the outsider only pays $50,000, then the excess will be $50,000, being the excess of the market value over the consideration given, and that $50,000 will be subject to family trust distribution tax. Another example is a loan. The Commission has a view and takes some support from the explanatory memorandum that an interest-free loan to an outsider is also capable of being a distribution that is caught by these provisions. When you do a net present value calculation, there is a benefit that's being conferred on the outsider if they're not having to pay interest, if they would otherwise have to pay interest where they got a third-party financing arrangement with a bank, for example. So there are a lot of different types of circumstances beyond just your usual conferral of a present entitlement to income or capital that could be caught in this broader definition of distribution. And it is important to consider the breadth of that definition whenever payments are being made to potential outsiders of the family group of the primary individual. So is this my slide, Michaela, or is this your slide?
This is my slide.
Okay, well, I'll stop there then. Thank you.
So we will now talk to who is a member of the test individual's family group. That phrase we've spoken to quite a lot during this discussion. So it's very important that one understands who are all of these members. And as Jonathan and I have both said already, and just to reiterate the point, where a family trust, so a trust that's made a family trust election or an interposed entity distributes or confers a present entitlement of income or capital to an outsider, as you will, somebody who's not the test individual or a member of the test individual's family group, family trust distribution tax will be triggered. So again, just reiterating, it is crucial to understand who are all of these members that fit within the test individual's family group. Now, the phrase family group is exhaustively defined in section 272(90) of Schedule 2F of the 1936 Act. There are essentially 10 categories of members, and these are all on the screen for your reference at the moment. Today, I will just touch on 3 of these categories, that being number 1, 5, and 6. I'll start with the specified individual's family. So the phrase or the term family is also exhaustively defined in the legislation. It's exhaustively defined in section 272(95) of Schedule 2F. And it only includes natural persons, which is a very important point to remember. It only includes natural persons, and it includes individuals such as the test individual, the parents of the test individual, the grandparents of the test individual, the brother, sister, nephew, niece, children of the test individual, as well as the spouses of all of those individuals I just mentioned. In terms of children, it includes a stepchild, an adopted child, and ex-nuptial children. And in terms of a spouse, this includes same-sex individuals as well as de facto partners. What is very important to understand is that the term family is not synonymous with the phrase family group. Each of these phrases come up throughout the family trust election rules, and it's critical to understand that these phrases do not share the same meaning. I've illustrated an example 2, just to illustrate this point. Here we have company ABC. Company ABC is 100% owned by company XYZ. Company XYZ has made an interposed entity election in respect of individual 1 for a family trust election for Trust A. Company XYZ is 51% owned by individual 1 and 49% owned by an outsider to individual 1's family group. And for whatever reason, we are asked to determine whether or not company ABC is a member of individual 1's family group. Now, if we just go back, I'm not sure if I can go back, but let me see if I can, to the 10 categories of members of the test individual's family group. The only relevant categories that are relevant, at least for company ABC, are number 5 and number 6. But we're not told that company ABC has made an interposed entity election. So let's assume that it has not. This means that the only relevant category that we need to consider to determine whether or not company ABC is a member of individual's family group is number 6. And what this category is essentially saying is that trust companies or partnerships where certain members, those members being the test individual, members of the test individual's family, or family trusts with the same specified test individual, where those certain members have fixed entitlements directly or indirectly and for their own benefit to all of the income and capital of the trust company or partnership, then that trust company or partnership will be a member of the test individual's family group. So let's assume that company company XYZ has all the fixed entitlements to all of the income and capital of company ABC, at least on a direct basis. The question then is whether or not company XYZ is one of those certain members that I just referred to. Is company XYZ the test individual? Clearly not. Is company XYZ a trust with that has made a family trust election with the same test individual? Clearly not. So then the question is company XYZ a member of the test individual's family? Now, we know company XYZ has made an interposed entity election, which means that company XYZ is a member of the family group, of test individual's family group. But this does not mean that company XYZ is a member of individual 1's family. And it is that part, member of the test individual's family, which is crucial for that 6th category of member. As I said before, family is just consisting of natural persons, of which company XYZ is clearly not. So the result of all of this is that Company XYZ is not one of those certain members that I refer to. So that sixth category does not apply in this case, which therefore means that company ABC is not a member of individual one's family group. The only way that company ABC will be a member of individual one's family group is if it makes an interposed entity election. Another point to keep in mind when it comes to the phrase family is Section 960-255 of the 1997 Income Tax Assessment Act. Essentially, what that section is saying is it treats certain relationships as it traces through to and from and through certain relationships with a child within its extended definition. So a stepchild, for example, or a spouse within its extended definition, as if that child were the natural child or the spouse were legally married to another individual. The best way of illustrating this point and how this section may apply is an example that I've shared on the screen. Here we have individual A. Individual A is the stepfather of individual B. And there is also individual C, who is the brother of individual A. So therefore, the step uncle of individual B. What Section 960-255 does, it treats the step relationship between individual A and individual B as being a natural child-parent relationship, despite the fact that it's a step-parent-child relationship. And then what it does is that it traces through that natural relationship and treats individual C as being the natural uncle of individual B, despite the fact that individual C is the step uncle of individual B. So this section is also relevant because it may be relevant in determining who is a family member for the family trust election rules. Interposed entity elections. This is another way in which one can be a member of the test individual's family group. There are various requirements for making an interposed entity election. I won't go into the detail here. They're very similar to the requirements for making a family trust election. But what I will say is the main difference is the family control test for companies and partnerships. For trusts making an interposed entity election, it's basically the same family control test for passing a family trust election. But for companies and partnerships that are seeking to make an interposed entity election, they will generally pass the family control test if a certain group of people have between them, directly or indirectly, and for their own benefit, fixed entitlements to a greater than 50% share of the income or capital of the company or partnership. So one last point I'll just make in terms of interposed entity elections. Of course, it may be advantageous to make an interposed entity election. As we've said, if an entity makes an interposed entity election and a family trust wishes to distribute to that interposed entity or confer a present entitlement of income or capital to that entity, that distribution or conferral will not trigger family trust distribution tax because that interposed entity is a member of the test individual's family group. But there are some dangers in making an interposed entity election. For example, an interposed entity election where an interposed entity that makes a distribution or confers a present entitlement of income or capital to an outsider of the test individual's family group will also trigger family trust distribution tax. So that's important to bear in mind. Another potential danger, and it doesn't come up as frequently, but we have seen it come up in practice, is where a trust makes a family trust election in respect of one individual, one test individual, and that same trust makes an interposed entity election in respect of another test individual with its own family group. Now, you would think in this example that what has essentially taken place is that any distributions or conferrals of present entitlements can be made to a broader pool of individuals. But that is exactly the opposite of what is happening in this example. And I think the best way of thinking of this is having a Venn diagram. Basically, where a trust has made a family trust election in relation to one individual and an interposed entity election in relation to another individual, all distributions or conferrals of present entitlements will need to be made to entities or people that are within the family group of both individuals, so as not to trigger family trust distribution tax. So if we're looking at the example on the screen, where Trust A has made a family trust election in respect of individual A and has made an interposed entity election in respect of individual B, and that trust makes a $100 distribution to individual C. Individual C is individual B's son, and individual A's uncle. The question is whether or not that $100 distribution will trigger family trust distribution tax. And the only way that that distribution will not trigger family trust distribution tax is if individual C is both a member of individual A's family group as well as individual B's family group. So individual C needs to essentially be within that overlapping section in the Venn diagram. So if we consider whether or not individual C is a member of individual B's family group, well, clearly he is. It's individual B's son, so meets the definition of family, and therefore a member of individual B's family group. But is individual C a member of individual A's family group? Well, as I said, individual C is individual A's uncle. And the exhaustive definition of family in the Act does not extend to uncles or aunties for that matter. And so therefore, individual C is not within individual A's family group. So even though everybody seems like family, it is very important to keep in mind who is, based on the legislation, a member of the family group. I think this is where we've ended the most of the slides. We do have some additional case studies if there is time. However, perhaps there are some questions before we go any further.
Well, we've had one question come through. If you just bear with us while we have a quick read of it. So the question is whether a fixed trust can make a family trust election where two discretionary family trusts from two different families each own a 50% interest of that fixed trust. And the fixed trust has income losses and capital losses. So can that fixed trust make a family trust election? The answer will be no, because it won't be able to pass the family control test. Well, depending on, it's very fact-based here in terms of who controls the trustee of the fixed trust. But for the trust to make a family trust election here, it needs to be able to pass the family control test. So there'll be a question mark about whether that in these particular situations is done, which really requires not just the beneficiary holding to be looked at, but also the terms of the trustee and who has the position as appointor, and who has the position of the trustee, or who is the director of the trustee company, or who's the shareholder of the trustee company. The other issue with making the family trust election will be to ensure that when the fixed trust has made distributions, it hasn't been to an outsider. That is probably where the issue will come up for the trust being able to make a family trust election, where the election would be in favour of one particular primary individual, but the distributions would then be going to two different trusts with two different primary individuals. So it would not be, one of the trusts would not be in the family group of the primary individual elected in the family trust election. So there will likely be issues. What happens then with losses is the question. If the trust can't make a family trust election, well, it will come down to whether the trust is fixed or not, from the perspective of the Schedule 2F definition. So will the beneficiaries be taken to have a vested and indefeasible interest in the income and capital of the trust? Typically, the answer will be no, unless the Commissioner exercises discretion to treat the interest as being fixed. If he treats the interest as being fixed, then so long as the usual loss rules that apply for fixed trusts are satisfied, the losses will be available to be carried forward and used against future income. But if it's not a fixed trust, then those losses may be gone. Just a reminder that the loss rules only apply to income losses and not capital losses, so capital losses would be available to carry forward. Another question that's come up, maybe I'll pass that to Michaela, is what's the process to remove a trust from a family trust election? I think probably the question to ask there is what's the process to revoke a family trust election? Michaela?
Sorry, I was just unmuting my screen. The process for revoking a family trust election, again, is there's a detailed process in the legislation itself. There are some time limits that one has to have regard to, but again, one would look at that approved form that it needs to be made in writing and in the approved form, and needs to be provided to the Commissioner within a certain period of time. But generally, you have a 4-year period for which you are allowed to revoke the election. So we've seen this come up in practice quite often, that this 4-year time limit becomes quite critical in determining whether or not one can, this is an interposed entity election as well, but one needs to take into account those time limits, but the variation the variation and revocation form, NAT 2787, is where one should go to in terms of revoking that family trust election.
And another question that's come through is, can a beneficiary loan funds to a family trust? So the answer is yes, from just from the ordinary commercial perspective. Anyone can lend to a family trust. Will the loan to the family trust cause family trust distribution tax? No, so long as it's going from the beneficiary to the trust as opposed to the trust to an outsider, where that loan was interest-free. Is the repayment of the loan then something that needs to be considered? It is by the family trust to the beneficiary. But so long as the loan is repaying an obligation that is owing under a legal agreement, then it shouldn't be captured by that broad definition of distribution. So if the beneficiary is an outsider, the repayment of the loan money should be okay. I don't think we have any other questions, so we might call it there, but as I said, we do have a detailed tax paper on the topic, which we can circulate after the session, or we can give it to Teddy and Henry, who will do so.
All right. So, any other question? If you want to ask directly, you can put your hands up and then unmute yourself and ask directly. We'll probably give another 1 minute or two.
We don't have anybody unmuting, so
No?
yeah, it's a lot to take in.
Okay.
All right, yeah, no, we don't have any questions.
It is a lot to take in, so that's why the paper, I mean, you know, with the Tax Institute sessions, the benefit that the audience had was being able to actually read the paper in advance. So they had some context to a lot of the provisions, which are complex if you haven't looked at it closely before. But the paper will go into a lot of detail and explain things that we perhaps glossed over that may not have made sense. So that's why I think it's important to send that around for everyone.
Absolutely.
No worries.
Okay. Thank you very much.
All right. Thanks, Jonathan Michaela, for your time, for your expertise, and also for your insightful presentation. Your valuable contribution is always appreciated. So if any one of you need any further information, any question, you can contact Jonathan or Michaela directly, and I'm sure they'll be very happy to assist you and your client further. So Henry will circulate the paper from tomorrow, and if you don't receive the paper by the next few days, please contact Henry directly. And thank you all once again for attending tonight's session, and we hope to see you all back again in a month's time. And it will still be online session until further notice. So thanks, Jonathan and Michaela, and thanks everyone for joining us today. And see you next month.
Thank you.